What diversified investing means. Diversified investing means not putting all your money in one place. Instead, you spread your investments across different types of assets, like stocks, bonds, and cash, and then spread out again inside each type, different companies, sectors, countries, etc. The goal is not to avoid all risk. It's to avoid one bad thing ruining everything and to smooth out the ride over time. Why diversification matters? Reduces risk from one thing going wrong. If you own just one stock and it crashes, your money crashes with it. If you own hundreds of companies through funds, plus bonds and cash, one loser hurts less because others may hold steady or grow. Helps balance ups and downs. Different investments behave differently. When stocks fall, bonds sometimes hold up better. When one sector, like tech, struggles, another, like healthcare or utilities, might do okay. Supports long-term growth at a risk level you can live with. Diversification lets you choose a mix that matches your risk tolerance. How much roller coaster you can emotionally handle, and your time horizon, how long until you need the money. The building blocks, main asset types. Think of your portfolio like a recipe. Stocks, equities, higher growth potential, higher ups and downs. You can diversify across size, small, mid, large companies, sectors, tech, healthcare, energy, consumer, etc. Regions, US, international, emerging markets, bonds, fixed income, more stability, usually lower returns than stocks. You can diversify by type, government, corporate, municipal, credit quality, safer versus riskier, maturity duration, short-term versus long-term, cash and cash-like, savings accounts, money market funds, very stable, low return, good for emergencies and short-term needs. Some investors later add real estate or commodities, but beginners don't need to start there. How beginners usually diversify in practice. For most beginners, the easiest way to diversify is not picking lots of individual stocks. It's using funds. Index funds, ETFs. One fund can hold hundreds or thousands of stocks or bonds. Example, a total stock market index fund gives you tiny pieces of many companies at once. Mix of stock and bond funds. A simple diversified structure might look like 80% stock index funds, 20% bond funds for a long time horizon and higher risk tolerance. 60% stocks, 40% bonds, more balanced. 40% stocks, 60% bonds, more conservative. This mix is called your asset allocation. It's the heart of diversification. Diversifying within each category. Even inside one asset type, you still spread out. Within stocks, different sectors, tech, healthcare, financials, etc. Different sizes, small, mid, large, different regions, US plus international. This helps avoid being overexposed to one industry or country. Within bonds, mix of government and corporate, different maturities, short, intermediate, long, different credit qualities, higher and lower risk. Funds make this much easier than trying to buy everything one by one. Rebalancing, keeping your diversification on track over time. Some parts of your portfolio grow faster than others. That can quietly change your risk level. Example, you start with 60% stocks, 40% bonds. Stocks have a great year, and now you're at 70% stocks, 30% bonds. You're taking more risk than you planned. Rebalancing means selling a bit of what has grown too much, buying more of what has fallen behind. So you return to your target mix, like 60-40. Many experts suggest checking at least once a year or after big market moves. Common beginner mistakes with diversification: owning many funds that all do the same thing. 5 US large cap stock funds is not real diversification. They likely move together. Over-concentrating in one stock or sector. For example, having a huge chunk in your employer's stock or only in tech. Thinking diversification means no losses. A diversified portfolio can still go down, especially in big market events. The point is to reduce the damage, not to be invincible. Never rebalancing. Letting winners run forever can quietly turn a balanced portfolio into a very risky one. A simple mental picture. Imagine you're building a garden. If you plant only one type of flower and a bug loves that flower, your whole garden suffers. If you plant many kinds, flowers, shrubs, trees, some may struggle, but others will thrive. That's diversification, different things in different places. So one problem doesn't ruin everything. Important note. A good next step is to clarify your time horizon. When will you need this money? Clarify your risk comfort. How much up and down can you emotionally handle? Consider talking with a licensed financial professional before making decisions. Portfolio overview, beginner-friendly mix. 1. Stocks, 60%. Growth engine. U.S. stocks equals strong, long-term growth potential. International stocks equals reduces dependence on one country's economy, helps younger investors grow wealth over decades. 2. Bonds, 30%, smooths the ride. Bonds don't grow as fast as stocks, but they help steady the portfolio. Useful for beginners who don't want extreme ups and downs. Matches the idea of balanced portfolios, like the classic 60-40 model. 60% stocks, 40% bonds, used in many examples. 3. Cash, 10%, flexibility plus safety, good for emergencies or short-term goals. Prevents needing to sell investments during market dips, examples for educational purposes. 40% total U.S. stock market index fund, e.g. VTI, FSKAX, SWTSX. 20% international stock index fund, e.g. VXUS, FTIHX, 30% bond index fund, e.g. BND, FXNAX, 10% money market fund or high-yield savings. This keeps things simple. 3 to 4 funds total, which aligns with expert guidance that beginners can diversify well with just a few ETFs. If you learned anything from this video, consider like, subscribe, and share. Thanks for watching.